Hello everyone, it's me the Boss Hog. It's been a week, that's because I've been extremely busy with my new job and I didn't have a chance to do an earnings roundup as a separate video. But don't worry, today we're going to be looking at the better part of 10 companies, one of them in quite a lot of detail, so let's do it. Actually, we're also doing this update in my bedroom just because it's slightly further away from where my little bit poorly daughter has been sleeping, but the light seems to be quite good today, so that's a bit of a result. So first of all, in terms of the week, it was honestly pretty flat, but it was quite an interesting week because both Tuesday and Wednesday were mental for one reason or another, and then the start and end of the week were actually quite boring, or it all just seemed to even each other out. When we get to look at the actual company's breakdown and how they're performing, you'll see that there's sort of one company that's really supporting my portfolio at the moment, and then actually some of my larger holdings had real pullbacks that were sort of only sort of 5%, but you know they're quite substantial parts of my portfolio. So overall, depending on which table we use here, down sort of about 0.3%. So minus 430 is what I got from my Google Doc. Minus 363 is what I actually got from my portfolio. For those who didn't see last week's video, the table on the right here is taken directly from my brokerage, so it's like the actual value that's in my portfolio. I thought it was important to start showing that. In theory, these two figures should match perfectly, but because of some of the sort of FX differences and the kind of the buy sell points and even like little fractions between sort of what Google Docs is doing and then what Trading 212 is doing, there's a slight difference, but this is like 0.1% on my portfolio value, so in the scheme of things immaterial, but over time I would expect those figures to be aligned essentially. No new capital added. I mentioned I had a bit of a break between my jobs, so we haven't had a ton of money to put into investments. I did get paid my improved salary on the 18th this month just because our weekends fell. So I do actually have some money in the bank at the moment, but between sort of various costs, etc., and my wife's request to probably build up our buffer a little bit, I'm not going to be putting any in for at least a few weeks until we sort of get December costs out the way. And yeah, there's been a few of them, so just no additional capital added as a result of that. Dividends were fine. I had hoped to be a little bit bigger on the dividend this week. I've got a house builder at Red Rose specifically that I'm due a pretty solid dividend from that I now expect to get next week. It was technically paid this week, but my brokerage hasn't processed it yet. But I don't pay for my brokerage, so I suppose I get what I pay for. And last but not least, I've been trying to sort of add a graph in for each one of my videos. I don't think I've shared this one, or if I have, I've not done it for a long time. This is my profit over time. So I started in late November 2020. So basically 2 years now, and you can see it was very steady, right? I caught on that 2021. It was almost difficult to find a stock that didn't win. And then that big drop there is sort of February this year when the Ukrainian war happened. I had sort of 10% of my portfolio in a couple of Russian miners, and that's still why my blue line here for UK stocks is sort of minus 10. That basically is almost entirely from those Russian miners. My US positions have been doing better, and it means that my overall profit for my portfolio is like 2,500, just over. So yeah, that's how it's looking at the moment and over time. It also means that I'm not particularly swept up in the kind of somewhat bull market that happened over the last month, just because I've sort of had this at least twice over the last year. So I kind of see it at the moment as a little bit of a bull trap. From my perspective, I've reviewed all my companies over the last sort of 6 months or so. I feel comfortable with my portfolio at the moment, and actually I feel kind of good that I'm sort of in profit despite the fact that some of my companies that I believe in are so red. So actually I feel kind of quietly confident that when things return to normal, I'm going to be in a really good spot. And some of my companies are still doing really well, up sort of between 20 and 50%. So that's also obviously been helping. So but that is how I monitor. And in terms of that flat line there toward the end, that's just because I program a month in advance. So you're basically just looking at the rest of November already set up. So as the day end closes on each day, basically takes a snapshot and chucks it into that graph. But that's how we're looking at the moment. So my portfolio is actually kind of at near or about all-time highs, but that's only because I've been adding capital. I have actually had much more profit in the past, and then wars happen, which is a very good way to destroy capital. And here we are. So yeah, that's the portfolio anyway. So not too many buys this week, but let's have a look at what I have been buying. All right, so I'm going to start with Kingfisher. For anyone who's not aware, Kingfisher is a DIY store primarily in continental Europe and the UK. Continental Europe is dominated by France and Poland, and then UK as well. They have a few brands, but ultimately this is a DIY business. Now, I think at the moment this is still pretty good value. I'm really happy with my buy price anyway in the 240s. It has been all over the place. It's kind of had a lot of analyst downgrades recently, and to be honest, I kind of view the business as a bit of a turnaround. It really lost track of its of its European mainland business, and has kind of done a bit of a recovery job, sort of simplifying lines, improving relationships and like products with trade customers, which I think has kind of helped. So yeah, I was more than happy to buy. I'm more or less flat on this at the moment, but I wanted to grow my position, which is admittedly quite small. And it's not without risk, this company, but it just looks dirt cheap to me, and I think there's significant upside. I'd also say as well, in the same way that sort of Home Depot has more trade customers compared to Lowe's, you've also got a similar situation with Kingfisher against Wix in the UK. So I think like Wix is a worse business to be owning at the moment. I'd much rather have a more trade customers as part of that. But saying that, by the way, for anyone who is in either Lowe's or Home Depot, I would say both of those businesses are superior to Kingfisher, which, like I say, is a turnaround, and it's not the same kind of scale or, frankly, goodness as a business. But again, for me, it was dirt cheap, and I'm more than happy to buy at this level. In terms of what I did with EPD and ASML, so EPD I caught quite well. I've been in EPD like 3 or 4 times over the last 2 years. This one's quite a small position, just about 0.5% of my portfolio, so it wasn't exactly a huge dividend. And ASML likewise, I don't have a huge position, but much bigger. It's about 2% of my portfolio. So I just decided to, rather than averaging up on both of these, so EPD would be about plus 12%, ASML is about plus 20%. I just decided to add to my ETF positions. So the iShares Clean Energy, I'm slightly red at the moment, just by a couple of percent. SMT is a sort of tech high risk or medium to high risk ETF. It actually owns about 30% of its ETF holdings in private companies. So just to give you some idea of the kind of risk profile of that. So I'm down about 10% on SMT and decided that I still want to grow my shares. I looked at it in detail a couple of months ago and really liked what I saw actually. So I'm actively trying to grow my SMT position at the moment. It's about 1.7% of my portfolio, and I would absolutely like to get that to about 3 to 3.5 is the plan. So not a huge buying week, but that's what I was doing with my dividends. All right, so we've got a lot to talk about here. Everything yellow is going to get at least a minute's worth of my time. Before we get into the ones that are yellow, I just wanted to highlight both Phoenix and Legal & General. Neither of them had any earnings updates over the last week, but they're both up sort of 5%. The reason for that is it's linked to the expectation that the UK government is going to be reviewing solvency requirements, so how much basically capital these businesses are required to keep. If they have to keep less, they can invest more, and they both of them have reasonable efficiency metrics for turning that into good returns. So I just wanted to address those, and then we're just going to go down this list that I've got here. So Huntsman, I actually want to spend a little bit of time looking into the detail. It's one of my kind of babies, I suppose. So I wanted to go into detail of what can look like quite an intimidating company. So we're going to start with DOTD. So this is sort of a mailing company, as in emailing, and it does kind of more intelligent mailing. So, you know, it will kind of link into your customer's CRM system and then sort of send customized messages. That sort of stuff is its kind of value add. If I'm honest, I slightly overpaid for this, but at the moment I don't mind the price at all for anyone who sort of wants a small, potentially promising, high growth kind of business. It doesn't easily sit within a product that one of the big tech boys has. It's kind of slightly separate. Kind of these mass processors and these mailing companies aren't exactly new, but it's more about just using intelligence to make them more targeted, more sort of data driven and smarter ultimately. Now I would say their results were solid, you know, plus 7% or so, and I thought it was okay. Like I say, I view the business as medium risk. It's profitable, it's making money, it does have a small dividend. But to be honest with you, considering the direction of travel at the moment, I considered the results more or less minimal what I would require to be happy about it. So it just about got there for me. The reason why I'm not exactly ecstatic is because I think there's a lot of growth opportunity in this area at the moment, and for me I wanted to see a little bit more considering the multiple I paid. I am down about 8% on my holding at the moment. But don't consider it too outrageous. I could have been a little bit more disciplined in buying this, but like I say, I'm quite bullish on the direction. So for me, it was a little bit disappointing not to see them do even better, but I thought the results were solid overall. Next up is AMKR. So I was surprised that it took the market 1 or 2 weeks to realize just how good the actual earnings were. They completely smashed their earnings. And, you know, I think this company for a long time has been dirt cheap, especially when it was down in the teens. It's been on a bit of a tear over the last few weeks, and this is now my best ever performing company. I'm up many thousands on it, on a very big position, and actually where it's been growing and gamma has been reducing is now actually my largest holding. So that's really awesome. In terms of its quarter specifically, it had record quarterly revenue just over 2 billion and record EPS at 1.24. So that's just for the quarter, right? Considering the share was trading on sort of $15-16 not too long ago, you can see the kind of EPS there was way too low for this company. In terms of year on year, I mean, the EPS is up almost 70%. For me, I think it's really starting to hit its stride now in terms of how efficiently it's scaled. It's got a lot of things coming up. It's grown into all the right areas. It's a real niche in the semiconductor space for what it does. It's absolutely smashed guidance, like I said, and it kind of, I would say their Q4 expectations remain relatively conservative as well. So they weren't getting too far ahead of themselves, but the market kind of caught up a little bit, in my opinion. I've had $36 on these guys for a long time, which looked a bit ridiculous when it was half of that value. Now it doesn't look quite so ridiculous, and I don't think it's the bargain that it was a few weeks ago. But I still really like what I'm seeing here, and I still think it's actually a buying opportunity just about. But you know, because the rest of the market now looks a little bit cheap as well, or at least in places, it doesn't look like the bargain that it used to. I would just add on top of that, they announced a 50% increase in their dividend, so 50%. Not exactly a big dividend payer already, and that's not why I own the business, but for me it was just another sign that the financial position is really starting to improve and get up and running. So actually I was pretty happy to see that as well. Next up, we got Genie here. Again, I thought their revenue and earnings being just above guidance was solid. Earnings especially were 8% above guidance, and that's despite pretty significant foreign exchange headwinds. They are still technically at a small loss for the quarter, and I expect them to be more or less break even for this year, which is fine. That's what they've guided. Their EBITDA technically is 15 million profit for the year, and then it starts to ramp up quite rapidly in 2023 and 2024. Now, for me, this is a company that's really working on establishing credibility. Since about January, I've been really impressed with how good their guidance and their deliveries have been. It's starting to reach scale. It's constantly landing new contracts. I definitely overpaid for this as well. And interestingly, it had a bit of a run-up before its earnings and has since had a bit of a pullback. And I thought the run-up was probably more fair of where it should be at the moment. And maybe some people were a bit disappointed by what they saw, but again, I'm really encouraged by the direction of travel for Genie at the moment. I'm still very red on this, about 40% red, but I'm kind of in this for the long haul now. Even if it turned green tomorrow, I'm just going to kind of ride it for the many years. Basically, it's a long-term hold for me. Even if I accept I overpaid in the past, I think it would now be a mistake for me to sell. And I've had that position for at least 9 months since I went on a kind of company presentation call in January. I've been quite happy with the direction of travel. So actually a little bit disappointed that it didn't kind of crystallize around the sort of $5.50 mark and has since fallen back. But again, I think this is going to be a volatile stock until it starts reliably making money over the next couple of years. Another company that for me had a really weird last few weeks, I would say that their earnings were quite disappointing. Revenue down 20% nearly. Income was down 50% year on year. EPS likewise. Now, I think, first of all, it got caught up in the kind of mini bear market that we had, but it went up something like 16% in one day, and I just couldn't believe that. Like, nothing fundamentally changed, right? Maybe it had been beaten down a little bit before, but it rebounded too strongly. And you know, 1 or 2 people are even talking about whether it would be a good opportunity to sell. For me, I'm about even at the moment on my T row position, and I think really the reaction was kind of almost one of relief. The assets under management were only modestly negative, I would say, and they have still plenty of cash on their balance sheet, so that looks really good as well. Likewise, dividends continues and doesn't seem to be under any immediate pressure despite the situation. So yeah, they're returning sort of $0.50 in the form of buybacks and dividends, which again is my sort of preferred mechanism. Actually, I like a little bit of both. And I'm sort of assuming, like, and the way that I choose to look at T row is it's kind of a multiplier. So, you know, because of the fact it kind of benefits from its assets under management, there are ultimately 2 ways it can grow, right? It grows by acquiring net improvements in people giving it money, and then it grows by the market kind of growing the assets under management for it. And, you know, a combination of sort of the market sort of showing recovery and then the assets under management not being as bad as feared, I think that kind of multiplied it more than it probably should have done. And likewise, previously, the multiplicative effect was too harsh. It was like falling too quickly, especially because, like I say, this is a well-capitalized and conservatively run business. So I don't think we need to panic. It could withstand a significant period of shock, basically. So I thought the T row earnings weren't great. But to be honest with you, the expectations were incredibly low, both for myself and for the wider business. But I still thought the reaction was completely weird, and pretty mental to see as a still fairly new investor. So it was okay. And yeah, I think if you're in Tiro, you need to be sort of mindful about the reasons why you're in it and the sort of cyclicality. And indeed the fact that it is kind of multiplicative, you need to be kind of quite comfortable with quite big swings, and that's kind of what we're seeing at the moment. But again, I think even if you got into this business and you were buying shares, 180, there's no reason to be sort of concerned. You'll get your money back eventually. The market does its things, right? Again, I wouldn't be concerned. Next up, though, a company that I would say comfortably beat expectations is ASML, another company that's been all over the place recently. I think if anyone was buying these shares under 400, you got an absolute steal. I thought these were really solid results, basically. I think there was a lot of concern that they were going to sort of be beaten up, both because of the China sort of trade war, for want of a better word, as well as the fact that, semiconductor as an industry isn't particularly well loved at the moment, and I think there's actually tons of buying opportunities across the semiconductor space. Yeah, I thought these results were really solid. Very strong guidance as well in growth, actually. Like a few of the companies, like AMKR included, were quite modest and guarded in what they were expecting, but ASML were really bullish. They sort of see very significant growth for the next better part of a decade. Significant buybacks, just broadly speaking, positive across the board. I think they have a pretty unique offering that's difficult to replicate, and if anything, the kind of geopolitical tension should actually favour them. They weren't really selling too much of the kind of higher, the higher tech stuff, so the smaller nanometer measurements to China anyway. Where China is still quite lagging compared to the West in that regard. And again, it's just kind of the kind of trade and its technology situation just makes it more in demand and not less over the next few years. So yeah, I think if anyone was buying under 400, you picked up an absolute steal. I think around its current levels, it does look expensive, but you can justify the reason why it's expensive. I'm sort of in between those two figures, so like I'm up about 20% at the moment, and I'm very happy with that, honestly, for what's meant to be a very long-term hold for me. And we just ride it now, basically. But so I don't think it's a terrible thing to be buying ASML at current levels. I just don't think it's such a bargain compared to what it used to be. But again, I think if you're bullish and agree with them over the next 10 years, it doesn't hurt either. Another company that actually smashed it was Kainos. This is a company most people probably wouldn't have heard of, but actually if you're familiar with Workday, so the American listed company, you may well have come across these. Kainos is Workday's main European partner, so it resells its service. And Kainos also has a secondary income stream where it does customized solutions, so sort of automation, just bespoke IT solutions, etc., software specifically. So again, Kainos here had really strong numbers, and it was already expected to have relatively strong numbers, I would say. It had a good last quarter as well. And for me, I would much rather own Kainos than Workday. It's very profitable, whereas Workday is struggling to be profitable. It's a much smaller company. It has way more ability to sort of multi-bag over the last few years. And so you're almost getting like a play on Workday, but for a much better, and I would say a much better company as it is today, and much more upside as well in terms of the future as well. So Kainos earnings guidance were both increased for 2023 and 2024. It had already actually increased them slightly for 2023, so further increase on top of that. And I mean, I've got their wording here. They said their growth, strong demand across the board, and demand has never been higher. That was their wording. So they saw a 16% profit and a 26% revenue increase. And the other thing I think was worth highlighting here is that their backlog of orders, so basically their work that they've already got contracted, they just have to work on, is up 120% year on year. And the Workday practice specifically is up 160% year on year. So again, I think that's really strong. I've worked with Workday as a solution. I think it's a very good HR tool, basically. I really liked it. And yeah, I really like Kainos as a better play and a less risky play compared to Workday. It's still a fairly small IT company, but it's not so far away now from the FTSE 100, and my expectation here is that it should make it into the FTSE 100 the latter part of this decade. It's about number 40 at the moment, I think, in the FTSE 250, so it's definitely up there. But it's one of those, again, IT companies that most people have never heard of. Next up, we've got MPW. So this has been much discussed, I would say. This isn't something that's kind of unique to me. I am much more on the bullish side of MPW at the moment. Again, I think if you were buying this in the $10, you got a screaming buy that's at least half price at that kind of level. I'm pretty red on this by about 20%. I think my average is about 14. I would say MPW was pretty mixed. He had a modest beat on both his EPS and its adjusted FFO. It also nudged up its guidance, but I mean, nudged up, it was like 1 cent, so very, very fractional. It's also been reducing its debt. It's started to look at buybacks as well because it argues, or its management team at least argue, it's undervalued. And it also had a sale of some of its facilities as well from a company called Prime, which also helped sort of improve that situation. It maintains its dividend. The payout ratio here at 80% for a REIT is absolutely fine. I've read almost all of the bear stories I can come across. I think there are some points to the bear argument for MPW, but even when there are, I think they're massively overdone. Things like steward being a large part of their income, I totally get it. That's a valid point, but that's been reducing. I think things like having stakes in the companies that you're renting from you is absolutely fine for a niche provider that presumably knows the market, and is not unheard of in again, niche REITs, including healthcare REITs. And likewise, well, I think the healthcare REIT as a sector is underloved, but actually I think for most of it, it makes sense why it's underloved. I'm not really a big fan of things like care homes and things like that. I think they'll take many years to recover, whereas I think a pure play hospital REIT here is kind of underappreciated and isn't directly comparable to its peers or companies that are often seen as its peers. I kind of like to view it in the same spirit as Vici, where it's a real niche player that until recently also wasn't really understood or much loved, and then kind of started that journey. I think these assets that both the likes of Vici and MPW own are often quite marquee, very difficult to replace, so that even if your tenant goes bankrupt, you've still got a rentable asset there that somebody else will happily pick up. It's not like with sort of care homes that are easy to build and very low barrier to entry. So yeah, I saw MPW. I was happy enough with the updates. I might do a bigger review when their next earnings come out, just because some more bear stuff has been published. But I don't really have too many concerns about these at the moment. And I think, like I have a target rate of like $20 to $21 for this share, which again may or may not be reasonable to most people, but that's where we're targeting. And therefore, I think right now it still looks like a reasonable risk reward play, and not without risk, by the way. But I think for those with a moderate risk appetite, you can justify pulling the trigger at these kind of levels. And the last company I just want to have a quick summary of is DLR. I thought the results here were okay, solid to okay to solid. Revenue is flat, FFO was up fractionally, margin was also up fractionally. Their guidance was quite strong. I would say that they were quite bullish. They've got a lot of European stuff coming online, especially. But I would say that like the fact that in the last 4 quarters, 3 of them have been records for the companies, again to me indicates pretty strong promise for the future. And yeah, and sorry, just one more as well. I made some notes this time because I've got so much to try and remember. They also did a large purchase in South Africa as well for a little bit under 2 billion. So again, I expect that to come good over the next couple of years before that's value accretive as well. That's got a relatively short payback period, so I think they've got a good buy there, perhaps aided by FX movements in their favour. So broadly speaking, lots of updates, pretty mixed, but mostly I was quite happy with what I saw, to be honest with you. Even where companies didn't exactly smash it, I thought the results held up reasonably well. And again, like at this point in my investment journey, I'm sort of really happy with my portfolio as a whole. So I'm not expecting too many horror stories. Just yeah, 1 or 2 here really stood out for me, mainly AMKR, but also ASML and Kainos would be the big 3 that I'd pick there for standing out. But even the others as well delivered reasonable results, and yeah, like even T-Row, which is like the worst one of these at the moment. I thought the market reacted positively, very positively, for some justification, even if it was slightly overdone. Anyway, that's the summary. But now I'm going to spend a few more minutes on Huntsman Corporation, which, like I say, is a big holding for me. So let's have a look at that now. All right, so we've got a 2-parter for Huntsman because there is a lot to get through and a lot of things that are quite unique, both about the company itself and also about what's been happening over even just the last quarter. So I'm actually going to start here at the bottom with this waterfall. These are one of my favorite financial representations, and you can see here a big red line in terms of its PU, which is polyurethanes. We'll get to the 3 divisions in a second, but actually this is by far their largest, so the fact it was down so much really limited overall EBITDA here. There were some improvements in terms of the fact that this company for many years now has been focusing more on value than volume. It's really a big change over the last kind of 5 years that they've been hammering home on earnings calls for many quarters now. But even with that, it wasn't really sufficient to override what was a disappointing performance for one part of their business. So before we even get into the 3 divisions within the business, there's a few one-offs here that anyone who's new to Huntsman needs to be aware. So first of all, legal victories. So actually, Huntsman's quite strong in its legal victories. Won a couple recently, a huge one with Albemarle, which has almost all been paid now. That was sort of $600 million, so very significant for a company of this size. That was paid, I think, in 4 or 5 installments, but it's been really boosting their cash flow, which has been helping with their share buyback specifically, which we'll get to in just a second. But very positive if you're a bull in Huntsman or kind of a value investor. I think you can make the argument here that that's been a real improvement in the underlying business. They've also just recently won another just about $100 million, about 125 once you include costs as well, with Praxair here. So that is likely to be contested and appealed against, but again, the findings here were very quick. Actually, it was the jury settlement, and despite an element of complexity, it was a very quick jury finding. So I suspect that they have a very strong case within that, which will further enhance their cash flow next year. They also had a couple of insurance wins, and not quite as significant as those, but you're still looking at like 10 to 25 million in terms of like what is and is not an act of God, right? Or when plants were closed. They've been winning a couple of those as well, so that's also been helpful. This next one is quite significant. So there used to be 4 divisions within Huntsman. If you just go back 1 quarter, you'll see 4. And it was interesting because on the last quarter's earnings call, they did actually mention about the fact that they were exploring possibilities for the textile division. It has always been their kind of worst performing, kind of lowest margin. It is still profitable, but you were looking at like 10-11% margin. And I think it was still its smallest division as well. And in the last quarter earnings, they sort of mentioned that they were reviewing various options. Apparently they've decided to sell the business. I would say the sale price they got for it is okay. It's slightly above their current trading multiple. I'll say slightly, it's about 15% above their current trading multiple. So I would say actually getting rid of one of their weakest parts of their business for that. Maybe as I talk myself through it, that's not a terrible disposal at all. It will have some impact on their business. Obviously it's going to reduce revenue, but it will do things like improve margin, increase from that perspective. So it may well become a more efficient business, which is primarily actually why I'm in the Huntsman. I'm not really in Huntsman expecting it to become a massive revenue generating beast. This is really a speciality business for me, so I think that's fine, and I don't mind that at all. I think, like I say, they got at least an okay disposal cost, and that will hit next year. Worth adding as well that the price here, it's almost all in cash. But what Huntsman have done is they basically syndicated out the part of the buy that wasn't in cash to get cash. So Huntsman are now talking about this as an all-cash deal for about $750 million. So again, another very significant amount of cash flow that's going to be boosting them next year. Sort of with it by the end of H1 2023 is the expectation at the moment. Lastly, as well, they have a splitter. This is a chemical process. I'm definitely not a chemist, so I'm sure I'm not going to butcher what the actual process is, but it ultimately creates compounds that can then be used in other parts of the processing. So they built this in Louisiana. It's now online, but it actually takes 2 years almost to get fully up and running. They did say at the moment that they're running it not at the capacity that they could, and that's really as a part of a response to the demand, as in a lack of demand that they're seeing at the moment. So maybe not great timing in terms of when that's been going online, but again, hopefully as that gets up and running over the next sort of 2 years almost, that's going to be a major contributor as well in towards its EBITDA. So we have a look here at their divisions. Yeah, I would say polyurethanes was an absolute, well, verging on a mess really. EBITDA was down almost 50%. Cost increases are up significantly. They highlighted specifically gas, but also utility has almost doubled, as in utility costs have almost doubled. Specifically, they called out Europe and China. They said Europe, it's very clear it's in a recession. They even benefit from slightly cheaper European gas prices because most of their manufacturing is done in the UK, the gas heavy stuff, which is slightly cheaper than mainland Europe, but still not exactly cheap, as I can attest to. And likewise as well, they believe that China at the moment is sort of struggling, which I think again won't be a surprise to anybody. They also spoke a lot about inventory destocking for its customers. okay, we'll take it. But also as well, very weak guidance here. They think it's going to be sort of another few quarters. The way that they described 2022 compared to 2023 guidance was effectively it's going to mirror. So as 2022's gone on, it's basically got weaker. As 2023 goes on, it's going to get stronger. So again, here depends what you think whether that's true or not, but you need to be very mindful that this part of their business, especially now textiles have been divested as well, is still way over 50% of their business, about 60% of their business actually. So very significant. And if this division underperforms, it's going to drag everything down, which was actually a bit of a shame because the other two parts of their business put up reasonable numbers, I would say. So we'll start with the less good of the other two, which is performance products. So again, volume down, but income up. And that was sufficient to still produce an EBITDA increase of plus 7%. Challenges in China again, also amines here. So for anyone who's not familiar with amines, and until I started investing in this company, neither was I, this is basically cleaning products that they use in very sensitive environments. So we're talking sort of EV engines, semiconductor chips, those kind of things that need very specialized cleaning products as part of the manufacturing process. So supplying those kind of industries. But again, fairly weak guidance here, which was disappointing. Advanced materials was very strong. They use this stuff in sort of construction, kind of resins, foams, that kind of stuff as well. So they group it under advanced materials. A similar kind of theme here with the volumes down, but the income up. And again, a bit here, plus 20%, really strong. They did flag industrials more generally as an area for concern, but they did also highlight there was some recovery in automotive and aerospace. Aerospace especially has been really depressed for them for several years now, I think for very obvious reasons. They believe that wide body aircraft, normalization of travel there will be a big win for them. Automotive never fell as hard as aerospace, but again, they have significant exposure both to things like, the kind of molding of things like dashboards and seats in high performance cars, as well as the EV engine exposure here as well. So automotive never fell as far as aerospace, but it's recovering quicker. But aerospace here has a lot more upside. So again, you could potentially be quite bullish from that perspective. But I would say looking at this both year on year and even in quarter on quarter was a bit of a nightmare. That's really been emphasized by sort of macroeconomic weakness, oversupply that they're now trying to kind of minimize. And again, they spoke about this quite a lot in terms of like how looking to kind of run their factories in accordance with demand rather than building inventories. Again, this isn't a shock for me that would be their approach. And then as things improve, they can again improve production both at the stuff in Louisiana as well as the stuff also in the Netherlands, where they have a particularly large site. I think it's in Rotterdam. They're also looking, by the way, for anyone who's interested in the amine stuff, maybe you're interested in the EV/semiconductor cleaning. They're expanding significantly a factory they have in Texas. That will go live sort of toward the end of next year. But again, that's a significant upgrade as well. So I'd expect to see further improvements in the amine production, specifically for high performance cleaning products, chemicals, as part of that. So that's an overview. And then I want to go on to now part two, where we'll be looking at like valuations and my opinions about the valuations, especially considering sort of both their current PE and EPS, as well as what we'll be expecting to see in 2023. All right, so this time we're going to start at the top. This is just taken from their presentation, but I thought it was a good summary actually. There was toward the end. For anyone who's never been on a Huntsman earnings call, they're kind of funny because the guy who founded Huntsman, he's still heavily involved as the chairman, and he basically gives himself a lot of leeway in terms of what he speaks about. So he's always quite honest, and you end up getting like political and economic summaries that you maybe wouldn't get from other CEOs. So he's like really cutting, for example, about Europe's energy policy. And there's a few other things in there as well. They're just good fun to listen to. You sometimes get like surprised by the level of honesty. So he gives himself this kind of summary where he looks at the future. But this is a nice summary this time, so I decided just to take it. So reasons why I think you can be positive here. These would be the ones that I'd call out as well. Super shareholder attractiveness, basically, both in terms of a very strong dividend as well as a very, very strong share buybacks. And just to show you what that looks like, that they've reduced their share count by 20% in 4 years. And of that, half of it has been over the last 12 months. So now, in fairness, I don't expect it to continue at that sort of pace because it's been aided by these lawsuits. and income from that. But I do still expect that policy to continue. And again, I'm always interested in a company that's reducing its share count. That appeals to me basically. It does still have a lot of strong balance sheet. They do have some debt coming due over the next couple of years, but their first repayments in 2025, and it's for 300 million. And they've got the better part of 2 billion available in sort of cash and easy access to sort of banking loans and stuff like that. So I have no issues with their capitalization. I think it's a well capitalized company. The splitter here we've already spoken about in terms of its new investments. And then, yeah, some of the stuff coming in from sort of performance products as well is covered there as well. It's basically what I've already spoken about in terms of the semi and the EV space and indeed the insulation stuff from that perspective as well. I would say that Huntsman over the last few years has definitely simplified itself as a business, which might not be an obvious thing because it's quite easy to get intimidated by what's effectively a chemical company. But to me, it's made itself an easier to understand business. It's smaller, but it's more nimble, higher margins, etc., etc. So I still think, although Huntsman is still exposed to elements of cyclicality, it's moving in all the positive sort of strategic directions, which are improving over time. Again, I think I've spoken about the improving fundamentals as well will be good. And then, yeah, there will be some cash landing. I'm expecting to see at least half of the 750 million put into dividends. I think to me that would make some sense. And then ultimately, if there's any buying opportunities, great. If you look at the direction that Huntsman's been buying in, it tends to be in relatively small, high margin niche manufacturers. They typically spend somewhere between 100 and 300 million. So again, I can easily see them sort of buying 1 or 2 acquisitions from that as well. So that to me makes sense. So that is basically a bull case. All of those situations, like if things are going to improve, then great. The bear situation, these are all perfectly valid as well. Yeah, the macroeconomic climate, for want of a better word, the fact that the energy costs are all over the place is unhelpful as well. I mean, they were speaking about the fact that they need to reorganize Europe just to make it to give them the required returns, and they actually expect Q4 in Europe for polyurethanes to be loss-making, just to show you sort of the challenges that they're operating at the moment. They also call out higher interest rates in the US, which they expect to reduce construction. I would say that's not a huge concern for me, just because it's a relatively niche. It's the smallest part of their business, right, in the advanced materials, and it's an aspect of that division. But obviously, they are concerned enough to call it out. It would definitely be a few percent of their revenue and earnings, so it's not to be discounted entirely. They expect China to continue to be a challenge, but they expect it to rebound, especially as the latter half of the year goes on. The next one's quite concerning for me in terms of lower EBITDA. That's disappointing. There's also increased restructuring spend here. So the figure that they called out was $70 million in terms of restructuring, layoffs, etc. But they expect to be saving 40 million a year. So sort of a 2-year payback period here. It's reasonable for me. Mainly from sort of relocating offices. So the main one is into Krakow, Poland, where they're sort of relocating a lot of their back office stuff. And they do talk about at least 40 million, but I think for now 40 million is the figure you should use. So again, they're constantly looking at costs as a business. It's something that appeals to me. Like I'm not really revenue vanity driven. I'm much more interested in the earnings of a business. Like this is not the biggest business. It's sort of 6 billion market cap, but it's also not the smallest, and it is mature for a business. It's been around for many decades, and so there is an element of that kind of cost discipline that you see in those sort of businesses that have been around for a while. So what does this mean in terms of its financials at the moment? So their last quarter has a fractional EPS miss, but I'm talking less than 1%, and revenue meet, and again technically an exceeding by 1%. So broadly speaking, met them. And so if I look at their trading for quarters, you get a PE ratio of 6.7. So that's a current PE basically, not forward. And that was based on the share price closing on Friday. So it's pretty cheap, I would say. And by the way, when you compare that to sort of the S&P, you end up with sort of ratios for even basic chemistry of like 9, and advanced chemistry is like 11. So for me, it's fairly easy to sort of immediately just look at a sort of multiple expansion here to justify an increase. However, you've got a few things here. So first of all, there's significant uncertainty for 2023. Huntsman called this out themselves in Venice. There's lots of things that will have a fundamentally big difference on their numbers in terms of earnings. One of the biggest will be the gas input prices. They're hoping for sort of a mild European winter, to help manage that would be producing some upside. But it doesn't take much movement in the cost of some of the utility and input costs more generally to have a big impact. So there's that to consider. So for me, I have actually reviewed my numbers now. So I had 36 for this company for a while. I sold out of what was a huge position in Huntsman about a year ago for around 35. I missed a lot of the upside because it did go to 42, but then it fell right the way back down to like 24. My current buy price is in the 28s, so I'm still really happy with that buy price, to be honest with you. And I would say the business does deserve a slight improvement, but not a ton. I still remain very optimistic about the long-term direction of this business, and like that range of pricing there, it's really just looking at the multiples that you could get in across the sector more generally. There's obviously a concern here that the manufacturing for Huntsman specifically is going to get worse. I think that's a fair argument, but it still to me looks like reasonable value considering you've got good capitalization, you've got good cash flow, especially from sort of the disposal, as well as another lawsuit that they will hopefully win at appeal as well. And you basically got a falling share count, which is ultimately good as well. So I'll expect EPS to kind of hold up relatively well, even if EBITDA reduces slightly. We'll see what that looks like though, obviously in sort of a quarter or 5. But yeah, that's sort of my my range, and I'm sorry that's such a huge range as well, especially in terms of percentage. But it is difficult really because there's so much uncertainty across these businesses. But for me, it's still a business I'm happy to own and would be buying more of at the current levels, because I think there's sufficient upside that despite those risks and that lack of certainty, the strategic direction still makes a ton of sense, and I have no doubt that they'll make it to sort of the next upside on the cycle. Yeah, I don't need to explain that any further. It is worth adding though that I'm sort of very confident in the direction that they're moving into. This is kind of what appealed to me last year when I did have a huge position in them. It's just the fact that like it's a good play to some of the more exotic, high growth areas of the future, especially in like the EV space. Like it's so hard to find an established profitable company in that space, right? That's not either ridiculously overhyped or just a basket case for some other reasons. So it's like a good play on those kind of things without getting too much exposure to them if it doesn't materialize. Similar to semi as well, like this is a cool thing on the semi space. I have plenty of exposure to semi, so I don't necessarily need more, but I don't hate it either. To be a bigger part of that production process is fine with me as well. And then yeah, some of the kind of construction areas, again, this tends to be sort of not your general more simple business models in terms of construction. Yes, some high-end products that will be used for things like insulation and along those lines as well makes me quite excited. So that's my take on it anyway. Yeah, and generally speaking, like if you want to buy this now, I'd say it's not a terrible price at all, and you may well get a good deal depending on how strongly it does recover. But you have to kind of believe that 2023 is going to be a difficult one. You have to be prepared to ride that out, I think, and you may well take the opinion that if you think 2023 is going to be rough, then actually it makes sense to hold off buying this company in the hope it decreases slightly, which you may well get. So yeah, I think it's one for the somewhat brave, and I think you have to be prepared to hold this for at least 3 years in order to make it a worthwhile investment. But in the meantime, you will get presumably getting a decent dividend. You'll be seeing your stake basically increase through buybacks, and you'll get to be part of that. So I think I wouldn't necessarily say this is a screaming buy. To me, it slightly edges into the buy still, but only because I'm bullish about the company and not as worried as some others about the situation in 2023. So that's my kind of summary. I thought the results were okay, but yeah, the PU, the polyurethanes was a bit horrible, and I'm looking forward to seeing their cost reductions shake out in the future, not just in terms of what's happening in Europe, but they're doing things like exiting the PU business in Brazil as well, just because the margins are no longer there. So I think that's a sensible outlook that they're taking in terms of long term. Anyway, very overdue video, very long video. Hopefully that's been interesting all the same. Thank you very much for anyone who's been with me till the end and indeed waited for a week until my next video. Just a combination of, like I say, new job, little one being a bit poorly as well, and honestly I've just been knackered for the last week. It's really been tiring, so sorry it's taken me a week to get around to this, but hopefully it was interesting anyway. I do enjoy making these, just time consuming to do so. Thank you very much for watching though. I've been the Boss Hog, and good luck with your investing. Bye for now, guys.